3:30 p.m. Eastern Time, Friday. Wall Street is slowing down. Traders are closing positions. Risk desks are flattening exposure. Phones are getting quieter. Liquidity is fading. And then, it happens. The 10-year Treasury yield jumps. Not slowly, suddenly. Stocks hesitate. The S&P 500 drops 0.5% in minutes, then 1%, then more. Algorithms detect volatility. Selling accelerates. Within the final hour of trading, nearly $1 trillion in combined market value disappears from equities and bonds. Again, and once again. It happened late on a Friday. Coincidence? Or pattern? Because this isn't about one bad afternoon. Over the past decade, China has reduced its official U.S. Treasury holdings from now 1.3 trillion Tao at its peak to under 700 billion Yuan bon today. That's the lowest level since the financial crisis. Nearly half gone, not in one dramatic move, but steadily, year after year.
And when you include custodial accounts routed through Belgium, Luxembourg, and offshore clearing systems, China's real exposure to U.S. assets may still approach $1 trillion. That's not a small investor adjusting a portfolio. That's systemic leverage. Now pause for a second. The U.S. Treasury market is the backbone of global finance. It sets interest rates. It anchors mortgages. It determines corporate borrowing costs. It influences stock valuations. When Treasury yields move sharply, everything else moves with them. And when yields spike late on a Friday, the psychological effect multiplies. Because Friday afternoons are structurally fragile. Volume drops. Market makers reduce inventory. Institutions avoid carrying risk into the weekend. In thin markets, price impact expands. A moderate sell order can move prices far more than it would midweek. Now add this layer. Markets close Friday at 4 p.m.
They don't reopen until Monday morning. That's 65 hours of uncertainty. If volatility hits into the close, investors can't react. They can't hedge. They can't reposition. They can only wait. And waiting builds anxiety. By Sunday night, narratives start forming. Foreign selling. Rising geopolitical risk. China reducing exposure. Even without confirmation, suspicion alone increases volatility. And volatility alone can erase hundreds of billions in value. But here's the critical question. Why would China reduce Treasury holdings in the first place? Start with geopolitics. When Russia's reserves were frozen in 2022, it changed global thinking. Assets held inside another nation's financial system can become political leverage. China holds over $3 trillion in foreign exchange reserves. Concentration in dollar assets creates vulnerability. Reducing exposure reduces dependency. That is strategic risk management.
Then there's Taiwan. If tensions escalate, sanctions are possible. Selling slowly before a crisis is easier than selling during one. Now layer in trade, tariffs, technology bans, supply chain realignment. Financial leverage becomes part of the broader strategic equation. But here's where fear narratives often go too far. Could China dump $1 trillion in one afternoon? Technically, yes. Realistically, extremely unlikely. Because a sudden liquidation would damage China as well. They would sell into collapsing prices. They would devalue their own remaining holdings. A sharp dollar decline could hurt Chinese exports. Financial systems are interconnected. Mutual damage would follow. So the more realistic scenario isn't collapse, it's pressure, gradual reduction, strategic diversification, maintaining leverage without triggering catastrophe, and that is more powerful long-term.
Because markets don't require collapse to react, they only require uncertainty. Now zoom out further. The US dollar still dominates global reserves at roughly 60%. It remains central to trade and energy pricing. But that share has declined over the past 2 decades. Gold purchases by central banks have surged. BRICS nations discuss alternative settlement systems. Energy trade experiments with non-dollar contracts. None of this replaces the dollar overnight, but it reduces exclusivity. And when exclusivity fades, volatility rises. Because the system transitions from single-pole dominance to multi-pole competition. Transitions create instability, not constant crisis, but recurring tremors. Often during moments of weakest liquidity, like late on a Friday. Now let's talk about what actually happens when yields spike. Higher yields increase borrowing costs. Mortgage rates rise. Corporate debt becomes more expensive.
Growth slows. Stock valuations compress. High-growth companies are hit first. Tech stocks feel pressure, index funds decline, retirement accounts fluctuate, not because of conspiracy, but because of discount rate math. Even a 0.5% sustained rise in the 10-year yield changes valuation models globally. Now imagine this pattern continues. China reduces holdings gradually. Treasury supply remains heavy due to U.S. deficits. Yields remain elevated. Markets adjust to a higher rate environment. This is not collapse. It's repricing. But repricing feels painful, especially after a decade of ultra-low rates. The era of cheap money reshaped asset prices. A world of structurally higher yields reshapes them again. That adjustment creates volatility. And volatility attracts headlines. Headlines attract fear. Fear amplifies movement. But here's what history shows. Reserve currencies rarely collapse suddenly. They erode gradually. Through diversification, through competition, through slow reallocation of capital. The British pound did not fall in one dramatic afternoon. It declined over decades. The dollar remains dominant. But dominance is no longer uncontested, and markets are beginning to price that reality. So when you see late Friday volatility, it may not be a coordinated strike. It may not be an attack, but it may reflect a world where financial leverage is shifting. Quietly, strategically, gradually. The trillion-dollar question isn't whether China can crash U.S. markets in 15 minutes. The real question is whether global finance is entering a more competitive era where even the strongest systems feel pressure at their weakest moments. And if that transition continues, Friday afternoons may remain sensitive, not because collapse is inevitable, but because change is underway.
And markets always react before headlines catch up.